Okay, so what a year, huh? I mean, in a lot of different ways. Yeah, so it's been a very busy year. So let's start off. A lot of the statistics we look at every year. So let's see how the economy is doing, and we'll talk to you about what we see happening. We're off to a real good start so far this year. I mean, December was a nightmare. It felt a lot like 2008, and I don't want to feel that again in my lifetime, but it felt a lot like it. So gross domestic product, the total of the economy, it's made up primarily of consumption, how much everybody in this room consumes. You're the biggest piece. My concern was that the stock market fall that we had in October, November, and December is going to affect negatively consumer confidence. A statistic came out this morning that in fact happened. So consumer confidence fell quite a bit in December. It's still at a good level, but it fell a lot. So, so we got to watch that consumption. So keep spending. All right. So, so on average, going back to 1947, the economy has grown a little over 3% a year, 3.2%. That's inflation adjusted. So if inflation is 2%, the economy is growing 5.2%. And how we did last year, so we started the year, we always seem to start the year out slowly. I mean, just for the last 6 or 8 years, the first quarter has always been the slowest, a little over 2%. Then it really grew in the second quarter, over 4%. Third quarter was very good also, 3.5%. Fourth quarter is not in yet, but probably about 2.7%. So we're probably looking at 3% growth in the economy for 2018. That's a really good number. That's the best number that we've seen in years. New metric we look at, truck tonnage. So how much is being shipped? And truck tonnage typically tops out well in advance of a recession. So you can see the recession that we had between 2000 and 2001 when we had the dot-com bust, and then the other, of course, financial crisis back in 2008, 2009. You can see truck tonnage tops out before then, but truck tonnage is very strong. It's not topped out yet, so we just don't see a recession on the horizon. And interestingly enough, last month I saw a cartoon strip that alluded to a recession. So when cartoon strips are saying there's a recession coming, there's probably not a recession coming. And if everybody's talking about something going to happen, something else will happen. People just don't get this right. How's manufacturing doing in the country? We always want to be above 50. Manufacturing strong. It's over 54. It's good, but it fell 5 points in December. That was at 69 before this. So that's a big drop. 59 to 54 is good, but we think probably what happened is because of the tariffs, companies may have been front loading or trying to beat the tariffs with manufacturing and stocking up. So that could be why we saw the spike up to about 60 in November. And this usually peaks about 3 months, almost 3 years before a recession. So that, you know, if we peaked, we probably peaked a couple of months ago. Historically, that means you got almost 3 years before the next recession. Then we got the service sector. So although manufacturing's a significant part of the economy, the service sector is really the lion's share of the economy. Again, we always want a number above 50. It means we're expanding. And we're at 57.5 in December. That's a pretty strong number. Off the peak. The peak was about 62 a couple of months ago, but still a real good number. Unemployment, and this is the one, this is just doing fantastic. The average is 5.8%, and now we're at 3.9%. So unemployment, amazingly low. Then people filing for unemployment, the initial claims. We had back at the worst of it in March 2009 when it was on the news every night, 659,000 people filing for unemployment in a month. Now that's down to below 219,000. Yeah, so not only do we have low unemployment, but we also have not too many people filing for unemployment. Now this is good news. I mean, it's not barn burner news, but the labor force participation rate is now up to a little over 63%. That's a 5-year high. So it's not exactly like we have an upward trajectory, But people are starting to come back into the labor force who have been out of the labor force. So although unemployment is so low, we still think there's slack because there's people who have opted not to work. Now there's so many jobs available and the demand for labor is so high, people are getting paid pretty well. So they're coming back in. I see I missed one right there. Yeah, and then the low was about 3 years ago, 3.5 years ago, we were at 62.5% of the population. That was a 41-year low. This is an interesting one, job openings. So the JOLT survey. Bottom line, there's about 1 million more job openings than there are people to fill them in the country right now. That's a pretty impressive number. Okay, now remember how we're going to have robotics in the factory and the robots are going to take all the jobs? Wrong. Right? So where are we with that? Historically, factory unemployment has been almost 6%, 2.8%. So the overall economy is 3.9, factories 2.8. There is no unemployment in the factories. So the robots didn't take the jobs. You still need people to operate the robots. Yeah. Leading economic indicators. So some of the statistics we looked at, like unemployment, those are lagging indicators. They tell you what happened. We want to look and see what are the leading indicators or the indicators that tell us what we think is going to happen are saying. We want that to be over 0. It's at 1.41, so decent. You know, so again, not signaling any problems. And you can see the recessions were shaded. And the 37-year average, 1.29, so we're a little above the long-term average. This is the one, consumer sentiment. I forgot to update this slide this morning. So it fell to, let's see, the reading in November was 97. I think today it fell to 91, I think. So that's a significant drop. 97. Now 91 is still a good, strong number. The average going back to the 70s is 86. But I don't see how you could have 3 months in the stock market like that. And then the lead story on the news last night, if you have a 401k, it plummeted today. I don't know why they 401ks, like there's other types of accounts, but they just want to scare you. So if the stock market falls 500 points, the lead story is market plummeted. But if the stock market went up 500 points, it's buried in the middle to the end of the news. So just as a byline. So again, news always want to scare you. Don't let them scare you. Small business optimism. That's still pretty high, off the highs. So you're seeing a trend here. We're off the highs that we hit a few months ago for most of these statistics, but almost 105 for small business optimism. And you know, that's the election right there. So right or wrong, small businesses, after the election, the confidence just skyrocketed. The federal debt. Yep, we do this every year for you, right? Now we're up to $21.5 trillion. We're adding about $1 trillion a year. Nobody cares. I don't know a single member of Congress who cares. Of what, 535 people? I don't know a single one who talks about the deficit being a problem. It will be a problem, who knows when, may or may not be our lifetimes, but when it's a problem, it's going to become a problem overnight, and it won't be pretty. And put in perspective, from 1776 to 1981, we ran up $1 trillion in debt. And then we're at, what, 30 years, 40 years after that? And we added on $19.5 trillion. So, pretty sad. Now, you have to put the debt in perspective as a percentage of GDP. So, of the total economy. So basically, the federal debt is $21 trillion. The economy produces about $21 trillion a year. So we're at 104% of GDP. You'll see some other measures where they say you're 70-some% of GDP. I know there's two different ways to measure it. This is from the Federal Reserve, so I'll take their statistic. And now the deficit. So the debt is how much we've stockpiled in debt over the years. So we keep adding on every year another trillion, another trillion. That's the debt. The deficit is how much we add on in a given year. So that's where we're adding about $1 trillion a year on. And if you measure that as a percentage of the economy, it's about 3.5% of the economy. And back in the worst of the recession in 2009, the debt was almost 10% of the economy. So again, it's not, the 3.4% is not a number that would really get me concerned, but it's the trajectory that we're on where it just keeps going up and up. And then when interest rates go up, the deficit gets even higher because now we have to pay more interest on that debt every year. And then we get the baby boomers. The peak year for baby boomer births was 1957. So those people turn 65 in 2022. That's when the debt really starts going up again. And there's been talk about, well, we know consumer debt is down. So the consumers got the message back in 2008. The banks got the message back in 2008. It's still not easy to get a loan from a bank. Right, Mara? It's still pretty tough, right, Mara? Yep. So Mara's mortgage lender, it's still really tough, even 10, 11 years afterwards, to get a loan. But companies have been borrowing a lot of money, and a lot of them have been borrowing the money because interest rates are so cheap, they've been buying their stock back. So so consumer debt right now, or corporate debt as a percentage of what all these companies are worth, is about 38%. And it was as high as 51% in 1994, so kind of in the mid-range. Again, nothing really jumps out at me that says we're going to have a big problem. The Federal Reserve, so they've been pretty active last year, and they're the ones who caused all this trouble in October. So you'll notice you get a lot of communications from us when markets are down. You don't hear much when markets are up, because some people throw it in our face. Say, oh yeah, you call me when the market's up. But we want to communicate with you most when the stock market's down, because we know that's when you need to hear us. So at the worst of it in December, we were sending out pieces almost every single day, and Raymond James compliance was fantastic. And there's one, I think, on Christmas Eve that they had approved in about 4 hours for me. And this is all custom communications. It's amazing they approve it at all, but they do it very quickly. So the Federal Reserve, if you remember the communication we sent out at the beginning of October when the stock market took its first big hit last year, was that Chairman Powell said, well, we know we're going to keep raising interest rates, but we really don't know how much more. We don't know when we should stop, but we'll probably overshoot and raise them too much. So he's new to the job. This is his first year, but even he should have known that you don't say stuff like that. So with the Federal Reserve saying we don't know what the rate level on interest rates is, but it's almost like you got cancer and the doctor says, oh, we're just going to load you with chemo, see how much you can take, and then we'll back off once, and then we'll find the right level that you can tolerate. But until then, it's going to be very painful. So the stock market really floundered in October, a bit in November. And then toward the end of December, all of a sudden he came alive again, and he said, nope, we're not on autopilot, we're data dependent, so we're looking, we think that the Fed is pretty much done raising rates. Maybe they do it one more quarter-point hike next year, but inflation is just not there, as you'll see. But you can see that little stair-step pattern. So rates are still very low. Going back into the 1950s, the average overnight lending rate, which is the rate that the Federal Reserve sets, that's the rate that banks borrow from each other overnight, has been almost 5%. And right now it's only 2.4%. So it's still very low. Now last year, the year started off, if you remember, last year was just such a roller coaster in so many ways. So January started off great. Then at the end of January, the wage inflation numbers came out. That spooked the stock market. Stocks sold off. They didn't start. Then we had a great summer, June through August or September. And then come October, Powell speaks and the markets fall again. So through it all, in the beginning of the year, and even right through September, October, the 10-year Treasury, which is a very important rate because that's what mortgage rates are based off of, that rate got as high as 3.25%. So we started last year at 2.58, It got as low as 2.4, as high as 3.25, and then we finished the year at 2.69. Today, I think it's about 2.77. But still, that's still very, very low compared to the long term, almost 4.6%. Now, if you follow economic news at all, you'll hear about people talking about an inverted yield curve. And here's what that means. So you would expect, common sense, that the longer you loan your money to somebody, the higher the interest rate they're going to pay you. Or the longer you borrow money, the higher the interest rate you're going to pay. So if you're borrowing money overnight, you would expect to pay a lot less than if you were taking out a 30-year mortgage. But sometimes that logic is turned upside down, and it costs more to borrow money overnight than it does to borrow money for 30 years. So the yield curve, instead of being upward sloping, becomes downward sloping. And it makes no sense, but the reason it becomes downward sloping is because the Federal Reserve is, remember, they control the overnight lending rate, so they've raised that overnight lending rate so high that now the economy fears it's going to go into a recession, because remember, the Federal Reserve almost always screws it up. They almost always get it wrong. That's the big fear, and that was what we told you was our fear this time last year. So if the economy is going to go into recession, then we expect inflation to come down and the cost for long-term money comes down. So when you get an inverted yield curve as opposed to an upward sloping yield curve, every recession we have had has been preordained by an inverted yield curve. So every recession has been was preceded by an inverted yield curve. However, not every inverted yield curve has caused a recession. So where are we now? The difference between the 3-month Treasury and the 10-year Treasury is about 1/3%. It's not inverted, but it's pretty close to being flat, 0.3%. And I really don't think that's going to be a problem. I don't see a recession. And we've been saying that for the last several months, is we do not see a recession coming. The thing the Fed's always afraid of is inflation. So it's like, I mean, people can't get a 16-cent an hour increase in their paychecks, and the Federal Reserve has to put the economy into a recession because of that. So it sounds pretty ridiculous. So if we don't have high inflation, what's wrong with having unemployment at a level that we never thought was possible before? What's the harm? What's the harm with people getting pay raises if overall inflation is not a problem? And as you can see, the headline, consumer price inflation, which is everything. It includes food, energy, housing, everything in there. The 50-year average has been 4%. We're at about 2.2% right now, so half of the 50-year average. Then if you take food and energy out and you just go with just the core, you're still at 2.2%. And the one the Federal Reserve likes to look at is called the PCE, the PCE deflator. That's below 2%, 1.8 to 1.9. So the Federal Reserve has had this target of 2% for inflation. We're about there, but I think inflation's coming back in again. And really, I think you can thank Amazon for such a big piece of this, where everybody sells the same stuff on the same site. You can rank it by price, and so that really keeps the lid on inflation. And oil, and the headline is going to be coming down because oil has come down quite a bit. And oil seems to be about in the sweet spot now, about in the low 50s per barrel. So if we could keep oil between $50 to $60 a barrel, I think that's absolutely ideal, because now the people drilling in the U.S., and we're drilling, what, 11 million barrels? Yeah, we're drilling 11 million barrels now. The number just came out. That's incredible, the amount of energy we're producing. So they can make money, and at the same time, consumers aren't hurt because the cost of gasoline and natural gas isn't too high. So I'd say between 50 to 60 a barrel is perfect. So as I said, we do have a tightening labor market. There's no doubt about it. There's a million more job openings than there are people to fill them. But inflation's running about, wage inflation's running about 2%. There's nothing wrong with that. The average since 1960 is 3.3%. Now, one thing that hurt our portfolios last year, and some years it helps, some years it hurts. Last year, it hurt. The dollar got stronger. So that vertical dotted line is the beginning of 2018. And you can see the line, the graph goes up from there. So that means the dollar gets stronger. When the dollar gets stronger, other currencies go down. So dollar goes up, other currencies go down. Dollar goes down, other currencies go up. A strong dollar is good if you're going to be traveling overseas. You get to buy more euro and yen and rupees and whatever. But it's not good for big companies that do business overseas because their profits are hurt because they're getting paid in currencies that are worth less. It's not good for international stocks and bonds that we own because those are denominated in those currencies, those foreign currencies, and those foreign currencies go down. So in some years, like 2016 and 2017, the weak dollar was a tailwind for us. Last year it was a headwind. But if you look at it, so this chart is going back about 45 years. So here you can see the dollar index has really, that vertical line has gone nowhere basically in 45 years. So you get these wild swings every year. Nobody can predict them. I have yet to meet a single living being who can accurately tell me from year to year whether the dollar is going to be weaker or stronger. If we could know that, we could position our portfolios and make a lot of money, but you just don't know. So you just have to ride it out. Dollar goes up, dollar goes down. Some years it helps you, some years it hurts you. You can't predict it. That's just the way it is. But over a long period of time, it goes nowhere. Now the two big things drive the stock market. Nothing else. In the short run, the thing that drives the stock market is fear and greed. That's the short term. That's over a matter of days or weeks. But over the long term, only two things drive the stock market. Earnings, how much companies make, and interest rates. So a stock's price, theoretically, and I say theoretically because this is really hogwash, but the theoretical stock price is nothing more than the future cash flows that that company is going to generate, and you have to discount them back to today's dollars, and you discount them back based on interest rates and the risk that these cash flows will actually come to fruition. So it's those two things. So let's see how earnings have done. So in 2014, earnings were up 5%. So the S&P 500, largest 500 companies in the US. 2015 fell 12%. 2016 we're up 6%. 2017, excellent year. Earnings were up 19%. Last year, blockbuster, 29%. That's because of the tax cuts. It's because of a lot of things. It was because of business confidence. It was because of the tax cuts, revenue growth, productivity. It was a whole lot of things. 29%, just knocked it out of the park. So that's the estimate for last year. Earnings are up 29%, stocks fall. So the big takeaway from this is we've been really good since 2007, 2008 getting the macro picture right. So saying this is where we think the economy is going to go, this is what we think is going to happen. But you can be 100% right on the macro picture. It doesn't mean the stock market's going to move the way you think it's going to move. And there is proof right there. 29% and stocks fell, what, about 10% last year. The estimate for this year, stocks will go up 5%. So more of a normal year. But look at that, 2014 to now, so going from 113 to 170, that's why the stock market's up. And people will tell you the stock market's up based on nothing. It's up based on earnings and continued low interest rates. That's why it's up. Now this is something called the volatility index, or the VIX, V-I-X. There's an old saying, when the VIX is high, it's time to buy. When the VIX is low, it's time to go. Okay, so back in February, remember I was talking at the beginning of the year, wage inflation came out and it was much higher than people expected. So the stock market sold off. And you can see the measure of fear, or the volatility index, spiked on February 5th. That was a buying opportunity. Then December 24th, it was right up there again. Remember Christmas Eve? That wasn't a pretty day. That was, God, the market was only open, what, 3 hours? But, oh, what a terrible day. Well, that was the bottom. So fear always spikes at the bottom. And we rebalanced on the 21st. So 24th was the Monday. The 21st we were buying. You just got all your trade confirmations in. And we just locked in some amazing dividend yields because the stock prices were down, so we were able to buy them, plus we added to some of these positions, and we obtained some dividend yields of over 9% in the portfolio, 9 1/3%. So you don't get that opportunity too often. That was the time to get it. So, and we couldn't have rebalanced on the 24th because there weren't enough hours in the day. I can't hit my little finger, can't go that fast. Okay, so now let's take a look at the long term. Let's go back to 1900. So over a long period of time, we get these secular markets. Secular means long term. So a secular bear market where stocks go nowhere for 10 to 12 years, but it's not a boring 10 to 12 years, because if you think of 2000 to 2011, that wasn't boring at all, right? You had the dot-com boom, then you came back up into 2007 when everybody said everything's perfect, the world economy is growing synchronized, interest rates are low, this is as good as it gets, until the world financial system came within 2 or 3 days of collapse and it fell another 50%. So you go nowhere for 11 or 12, 10 to 12 years, but there's enormous volatility in the meantime, and at the end of those 12 years, the last person throws in the towel, there's nobody left to sell. The last person to throw in the towel says, why am I invested in stocks? I never make any money in them. I've been invested for 12 years. That's when the secular bull market starts, the next uptrend. Secular, again, long-term, bull markets last longer than bear markets, on average 16 to 18 years. We believe this current secular bull market started in fall of 2011. That's when we had the European debt crisis. That's when the US debt got downgraded from AAA to AA. And if you recall, that's when we were calling clients, recommending that they move up to the next aggressive model. So we have 7 investment models. Most clients were in Model 3. We suggested they move up to Model 4. If they were in Model 4, we suggested Model 5. We don't make those model changes very often, and we don't make them on our own without your permission. But the last one was in 2011. So if the bull markets last 16 to 18 years, we're about halfway through. But within these secular bull markets, you are still going to get cyclical, meaning short-term, bear markets. That's what we just came out of. Congratulations, you survived a bear market. A bear market is 20% down. It fell 19.8%. Close enough for me. Okay? So you survived a cyclical bear market. And the phones were quiet. And we had a couple of people who were pretty scared. But nobody threw in the towel. It was very quiet. And I think that's because we were just bombarding you with communication saying, this is what we're seeing, and we're just not getting it. And the reason we think, as we put in our emails, what happened, there are things called hedge funds. You've probably heard of hedge funds. There's a TV show on Showtime called Billions, and great show. It'll be coming on again this summer, I think, or in spring. It's about a hedge fund manager. And, but hedge funds, they're marketed as being only for the ultra rich. So you have to be in the selective few who have access to these. They're very expensive. They charge 2% a year. And on top of that, they keep 20% of the profits of anything they make over 5%. But they're crappy. So they do a great job marketing them, telling you you're special because you can get into this, but you're special because you get to buy this piece of crap. So investors are finally onto it. And this was the year they threw in the towel and they said, I'm sick of paying all this money for something that goes down in value or makes me any money. They can only get out once a year. So like with you, you can call us and say, I want out. We'll try to tell you our opinion, but if you want out, you're out. There's no cost or anything. You get your money in 2 business days. With a hedge fund, you only get out once a year. And if it's opportune for them, so they can tell you, I'm sorry, the gate is down. Nobody can get out right now. It's not a good time for us to sell. But this was the year hedge fund investors got out, and there were trillions of dollars that had to be liquidated. And hedge funds not only invest the money that people give them to invest, they'll lever up 10, 20, 30 times the amount of money they've been given. So all those trades had to be liquidated and unwound, which caused the stock market to fall, supply and demand. So prices plummeted. And then you have computerized trading now. So these computers are programmed where when a certain level is violated, a price level is violated, or there's news comes out, say, on a China deal, like yesterday, and all of a sudden you see the market spike. These are computers. They're programmed when a certain event happens, automatically buy or automatically sell. So prices were violated, the computers kicked in, dropped prices even more, and no. Well, actually, it gives liquidity to the markets. Yeah, and then at the end, mom and pop investor is always the last one to get out, and they finally panic at the very end. That's December 24th, and then they tell you the same story. I always get out at the wrong time, and I always get in at the wrong time. So as simple as, never want to sound overly simplistic, but the way you make money is by staying with the plan. I don't want to say stay the course, that sounds overly simplistic. We'll say stay with the plan, unless something's fundamentally changed, and it didn't. So that was last year, so we're still in a long-term upward trend, but yeah, that little blip, that little notch down at the end, that was a 20% fall. Scary, doesn't look like much, but when you go through it, it's scary. 2009, yeah, so 2019, should I put 2019? 2019. I should have put 2018. I'll fix that tonight. Yeah, so it was a rough year, and you can see I drew that little piece, the little tail coming up at the end, because this only took us through the end of the year, but that's how much we've gotten in January. So after today, I'd say we made back everything we lost in December. And December was a horrendous month. Oh, yeah, I've never seen our assets under management fall 10% in a quarter. That was a big drop. But yeah, stuff really looks sound to us. Now, this is one we try to show every year also. Put it in context. Every year, almost without exception, you get an occasional year, but the stock market falls every single year off its high. So far this year, we haven't. But last year, we fell 20% off our high. Again, definition of a bear market, but cyclical, short-term, not a long-term bear market. Stocks ended the year down 6%. The S&P 500 international stocks were down more than twice that. Even some bonds were down last year. But so 20%, that's a bear market. We've been there. And you can see it's not the first bear market we've had. The last one was in 2008, where we fell 20% or more. And then before that, I think that looks like, what was that? About 2001 probably, or 2000, where we fell 34% off the low, off the high, but we ended the year down 23. So what we went through the last year was not insignificant. It was very significant, but you made it. International stocks, we still see valuation there, and as you can see, look at the difference. So international stocks have gone nowhere. They are where they were back in around 2007. They've made no money for about 10 or 11 years. The holdings we have made money, but overall the index, the Morgan Stanley European, Australian, Far East Index, has made no money for about 11 years now. But look at the S&P 500 has. Although you can see, look at that drop at the end of 2018. Again, not insignificant at all. So you wrote out a pretty tough one in the last quarter. But just the gap between the two is how much international stocks have underperformed. And you know the old saying, buy low, sell high? But nobody wants to own something that's made no money for 10 or 11 years. They want to own what's hot now. But that's not how you make money. So that's why when we rebalanced in December, we were buying international stocks and international bonds because they were down last year. So they became a smaller weighting in our portfolio just because they sold off. So we added to them. And guess what? The worst performers last year are the best performers this year. So it's funny how that works. That's rebalancing is one of the simplest things you can do for success. So just putting it in macro picture, why we're still optimistic. So a few years ago, we talked about the second machine age, where the first machine age was in the late 1800s, the invention of the steam and perfection of the steam engine, how that led to the Industrial Revolution. Now we're in the second machine age, where we figured out how to harness computers and the internet for productivity. So we went from muscle power to steam power. Now we're going from steam power to mental power. And so Federated Investments calls it the Industrial Revolution 3.0. We call it the second machine age. But companies are structurally more efficient. They're substituting technology for people. They're substituting technology for capital. So Google and Amazon and Facebook, companies like this, they don't need enormous plants and machinery. They've got people. That's their capital. The result, you can grow your profits double digits, whereas your revenue, your top line is only growing single digits, but now you're becoming much more efficient, so your bottom line is growing double digits. As I said, the technology companies require very little plant, property, and equipment. They're more dependent on humans, and the amount of revenue they get per human employed is amazing. Now we have artificial intelligence coming. And artificial intelligence, I think, is in our lives already. You're just not seeing it so much. That can be something like Netflix sending you an email saying, we think you might like these new shows that we have out. So it's not some human being looking and seeing what you watched recently saying, oh, I think they'll like this. It's a machine that's seeing your patterns and giving you recommendations. So artificial intelligence is going to be just very, very big. Robotics, of course, in the factories, but as we saw, there's still very low factory unemployment. 3D printing, where we'll be probably printing human organs in the not too distant future, if we're not already. And the implications are low-skilled labor doesn't have as, is not as much in demand. Although you can say, you need just finding somebody to do low-skilled labor around your house. Good luck, especially around here. And you're going to pay top dollar for somebody. People don't come to your house and work for free anymore. It's a disinflationary environment. So even though the economy is so strong, why aren't we seeing inflation? Because of companies like Amazon. As companies don't need as much capital or don't need as much funds to expand, they don't have to borrow money. So now there's less demand for money. That means interest rates stay lower. Except the government's got a big demand for money. They need $1 trillion more every year. That's the risk. Companies become much more productive, and that's very critical because now we've got reduced immigration and we've got the aging population with people dropping out of the labor force every day. And this is from Federated, that McKinsey & Company predicts productivity from automation over the next 50 years will be 4 to 5 times the productivity we saw from the steam engine 100 years ago. You got to believe it. And just walking around my yard and I think of something I need and I take out my phone and it's Amazon like 30 seconds later and it shows up at my door the next day and it's a Sunday. So how do they do this? Oh, just amazing. Yeah. So then we come to labor productivity because we need labor to get more productive, and there's nothing really. I'm just shocked at how labor productivity is not showing much higher. I'm just wondering, are we measuring this right? Because think of all the jobs that used to exist just in an office that no longer exist anymore. And offices are run in hospitals. Everybody's run with fewer people. How can productivity not be higher than this? I just don't get it. It makes no sense to me. Here's what Raymond James expects for the year. And I think we're pretty much in line. Federated is a bit more bullish. The base case, which is what we think is going to happen, is that the S&P would end the year at 2957. I think today it's probably about 2660, 2670. And we were down to what, 2450 on Christmas Eve, I think? Pretty low. So Raymond James thinks we could see a 16% gain in the stock market this year if they have 65% probability of that occurring. I think they're conservative. I think this is going to be a banner year. You can hold us, say next year, you can say if we were right or wrong. I think this is going to be a blowout year for stocks. It's so unusual also to get 2 down years in stocks. It almost never happens. It can happen, but it's very, very remote. I think this is going to be a banner year. Here's the big deal. The Federal Reserve is no longer a threat. So I alluded to fall of 2011, when we called clients and we told them we thought it was time to move up to the next aggressive investment model. The other big thing that caused that to happen was we went to a lunch that was a person named Bob Doll, D-O-L-L. He's in his mid-70s, been investment strategist his whole life. And he said, he was on a plane traveling, and he had a thought that he doesn't know why it took so long in life to come to him. And this was when the economy was growing below its potential. It was weak. And his thought was, a weak economy is good for the stock market. You don't want a strong economy. Remember, last year was a strong economy. What happened? Stocks go down. Think, why is that? Because the Federal Reserve becomes a threat when you've got a strong economy. And there's, I think, got one more slide coming up here. We'll get to that one. Remember Wall Street Week? Show used to be on in the 80s, 70s, and 80s. Louis Rukeyser was the host. Used to be my favorite show. And yeah, there was a guy on there called Martin Zweig, or Marty Zweig. And Marty always had this dour-looking face, and Louis Rukeyser would interview him. He goes, "What do you think, Marty?" He goes, "I'm nervous, Lou. I'm really nervous." And Marty was always nervous. He was and Marty called the collapse that happened in what was that one-day drop of 25%? 1987 was it? Yeah. So the Friday before, I think that happened on a Monday, and Marty said, big one coming, a little big one coming. And that happened the next day, and he said, but it's going to be temporary. And I think stocks actually finished higher for that year, but it fell about 25% in a day. So Marty Zweig had a saying, don't fight the Fed. And I visited some people at Merrill Lynch. I was up there a few weeks ago just seeing a friend, and he showed me around. I said, oh, if we stayed with Merrill, we'd have a nice office up here. Believe me, you never want to go back, but nice offices. And one of the advisors up there was saying, don't fight the Fed. She remembered, I used to say that way back like a decade or so ago, don't fight the Fed. I got that from Marty. So when you got a strong economy, the Federal Reserve is hell-bent on putting the brakes on. They never lose. The Fed will never, ever lose. It's just a matter of time. If they want to slow the economy will stop dead in its tracks. If they want to stimulate the economy like they were doing in 2008, 2009, it's like, just be patient. They'll get the economy going. They never lose. It's just a matter of time. We don't have to fight the Fed if growth isn't too strong. So that's why I'm very optimistic this year. I think it's going to be a surprisingly very good year. We expect GDP to grow, or the economy to grow, about 2.5% for the year. Still decent, but nothing where the Federal Reserve is going to get concerned. We think earnings will grow 5%. Right now, the average expectation is about 8%, but they'll come down. They always come down. Suze?
Is interest rates the main way that they manipulate this?
Yeah. So the question was, are interest rates the way the Federal Reserve manipulates the economy? Yes. But here's what happens. So the Federal Reserve has what's called the Federal Open Market Committee, the FOMC, and it's a group of people who control the interest rates. But when the Federal Reserve raises interest rates, here's what they're doing. They're buying treasuries. So banks own treasuries, right? So if the Federal Reserve, so if the Federal Reserve wants to lower interest rates, what they're going to do is they're going to buy treasuries from the bank. And what do they give the bank in exchange for those treasuries? Cash. So they inject cash into the financial system. The banks lend that cash, and through the multiplier effect, it expands the economy. Now, if the Fed raising interest rates is a signal as much as anything. Yes, they are controlling the interest rate that the banks lend to overnight, and which variable rate loans are based on, but they're also sending a signal. Now, if the Fed wants to slow the economy, what they're going to do is they're going to sell treasuries. So the Federal Reserve owns a whole bunch of treasuries, way too many. They'll sell them to the banks. The banks buy them with cash. So we take cash out of the system. And that's what the Federal Open Market Committee does. Inflation, about 2% for the year. So not bad. I mean, not great, but we don't want great. You don't want great in the economy. We had great last year, and look what it got us. What else we expect in 2019? We think global expansion continues, but it will be slower than 2018. So growth slows in the US, but no recession. We think the Federal Reserve maybe hikes one more time next year. They were talking 2, 3, 4, not anymore. That stock market sell-off got their attention. Oh, and here's the other thing. The Federal Reserve is not only raising interest rates, but what they're doing is they're de-levering their balance sheet. So go back to 2008 again. Everything, I mean, we were within 2 to 3 days of world financial collapse. No exaggeration. The people down in PIMCO, Bill Gross and Mohammed El-Arian, who were really on top of this and saw it coming, they had their wives hitting every ATM they could find that week, saying, get as much cash out as you can. And on Monday, they thought the world economy had till Thursday unless the federal government stepped in and did something. And they did, and the Federal Reserve did something, and we had the TARP program, which the government made money off of. It wasn't a bailout. It was brilliant. The government made a lot of money off that. So, but that's how close it was. But back in 2008, 2009, you had all these mortgages out there, and people didn't want to touch them. The Federal Reserve bought them up. And the Federal Reserve made money on it. So the Federal Reserve is a money-making operation for the federal government. The Fed is not the government. It's kind of quasi-government, but the Federal Reserve makes money and turns the profits over to the government. And surprisingly, I think Powell, he was on CNBC. They said, what do you make a year? And he goes, I think about $150,000. So these guys are not very highly paid. Now, of course, they'll go out and make tens of millions when they retire, but they don't take that job for the money. So they were buying all these mortgages. They were still holding them all these years later, and now what they're doing is they're starting to unwind. They're going, we got way too much. So as this stuff matures, they're just letting it mature. They're not buying more, or they're selling some off. So that's called unwinding their balance sheet. It's just like raising interest rates. It's the same effect as raising interest rates. So even if they don't raise rates, they're still kind of raising rates by selling off or letting their mortgage securities mature. We think inflation declines more this year. We don't see interest rates changing very much. But we do see, I say it again, a significant increase in stock prices this year. And think, well, stocks are risky. We just had a big sell-off. They're less risky after the sell-off, right? They're risky before the sell-off. The risk isn't when the sell-off happens. It's done. You made it. Congratulations. You stayed with it. Now you're going to make money. And if you rebalance, you're going to do even better. So on January 4th, Jeff Sout, our Raymond James's chief strategist, his closing sentence on his morning tack, and this is on our website, updated every day with his commentary. He said, if you want to catch a wave, you have to grab it. He said, there's a big wave coming. You want to catch a wave, you have to grab a surfboard, get into the water. Ladies and gentlemen, we're at the point where you need to grab a board and get into the water. So I'd say it's about a week late, but still, he's there. I fully agree. There's Marty Zweig. I got to move that slide up a bit. Yeah, don't fight the Fed. That's simple. Don't fight the Fed. They never lose. Okay, so what's the Fed saying? Well, this is the day Jeff Sout put his commentary out in the morning, and then Powell talked a little later that morning. He said, particularly with the muted inflation readings that we've been seeing coming in, we will be patient as we watch to see how the economy evolves. It's like, hallelujah. That's what the markets needed to hear. They're not hell-bent. This is what we're going to do. We don't care what the data says. We're raising rates. We're delevering our balance sheet. We're on a course and we're not changing. He said, we have an open mind. That's all the markets wanted to hear. And why wouldn't they? Our concerns for the year, not as much a concern anymore. It was a concern last year, and apparently rightfully so. The Federal Reserve overdoes interest rates and hurts the economy, puts it in a recession. And it didn't happen last year, but that was our concern at the beginning of the year, because historically they have a very bad track record. And we think, okay, here's one, yeah. So I did this before the number came out this morning. Consumer confidence fades because of the stock market sell-off October through December. But I think when people get their January statements, maybe consumer confidence comes back a bit and they go, okay. China, a concern, China trade war escalates. I don't think it's going to happen though. I think we're getting close. So yesterday, news came out, then they retracted it like about 10 seconds later, but that they're going to get, you know, China's willing to start making a deal. We're not going to, yeah, we're going to lift the tariffs or something like that. And then 10 seconds later, go, no, we didn't say that. I'm going, huh? But then this morning, I think it's kind of alluding to that fact. Remember, as Jeff Sout always says, politicians have one thing in mind, one thing only, stay in power. So they will make a deal. because Xi doesn't want to lose power through a popular revolt. Trump doesn't want to lose re-election. They will make a deal. Another risk, and Jeff Sout's been alluding to this, says maybe Mueller does have the goods on President Trump. But my comeback would be, well, even if he does, and even if the House voted to impeach and went to the Senate, very, very unlikely the Senate, because the Republicans are in control, you need 60% of the votes. So the Senate wouldn't approve it. But let's say they did. I think the markets would skyrocket. Now Pence takes over as president. So you get the same policies without the drama. Yeah. I think it'll be the best thing to happen for the markets. Yeah. And finally, July 13th, barbecue day. Same caterer as last year. Yeah. Oh, thanks. So open it up to questions. Ted. Come on, Ted.
Do we actually?
Man.
The question was going to be what happens if he resigns?
Oh, Pence takes over. The market goes through the roof. Yeah. Yeah. Yeah.
And I think you're wrong on China. China's not because anymore than he has to. He's got Trump. Trump is so weak. You got to remember something. China's got the highest respect for the government in the world.
Yep.
New Social Security system, you can't open your mouth and you don't get your Social Security.
That's right.
You from birth to death.
Yep. It's
all my customers in China, my consulting business, are telling me luxury business is down. But you know what? Take a look at the East Side. The luxury buyers in China are here now.
I'll push back on that. Have you seen the luxury Chinese buyers disappear overnight? Yeah. So 3 people right here. Overnight, they're gone. Yeah, that's another thing, housing prices. So what's going to happen with housing prices? I'll tell you what I think. All the real estate agents I talk with, correct me if I'm wrong, think that we'll start seeing them go up again in the spring. Or you change your mind? I would say no. Here's why. I mean, I could be wrong. Because if most people are saying the same thing, something else generally happens, and when prices fall, they continue falling until they start back up again. Sounds overly simplistic, but sentiment stays negative until all of a sudden, overnight, it goes positive, then prices go back up. So, I mean, that could happen tomorrow, I don't know. But I say prices keep falling, and not collapse, but fall until sentiment changes and people think they're going up. That's my guess. But Ted's right. I mean, the Chinese government, I don't know if you know it, they track these people. You want to get into they track your behavior, what you do, what you say, and you want your kids to go to this school, you better be saying it and doing the right things. If you ever seen this show on TV, it's called Black Mirror, where people wanted high social media scores. They wanted people to like them, because if you had a low social media score, you were an outcast in society. It's happened. I mean, that was an interesting show. I think that was 2 or 3 years ago, and it's happening in China. Very scary stuff. Oh, question in the back. Was that Carl? Publishing suggestions on what to buy? Our models. Yeah, I can never discuss anything specific because of compliance in the room anyway, but I think we're there. Our investment models are exactly where we think we need to be. We let 2 funds go last year. We added a new one, changed the percentages a little in December, and I think we're in a real good place, and so far so good. You?
What is the consensus opinion of Chairman Powell?
Consensus opinion of Chairman Powell. I think good, except they felt he'd really screwed up in October when what he said was just unbelievable. I mean, how could the markets not fall, saying basically said, we really don't know what we're doing, but we're just going to keep doing it until we see a problem. And the markets are going, oh, my God, how could you say that? But it's amazing. Everybody in public office, they say the stupidest things, don't they? And I like to think, well, I guess if I was in public office, I'd say stupid things too. It just seems to be the nature. And the most intelligent people say the dumbest things. Yeah. Except my 6 years as a fire commissioner, scandal-free, scandal-free. You didn't read anything in the paper about Commissioner Fisette being on the tape with fire alarm company or anything, did you? No, you didn't. All right. Stan?
I understand that some of the Chinese tariffs are slated to go up January 4th.
Oh, I think in March, I think?
March.
Yep.
But there's also talk of
Yeah. So the question is, the next round of tariffs, which I think is $250 billion, is slated to go into effect, I think, in the beginning of March. What's the outlook on that? My guess is it's not going to happen. Just from the comments we heard yesterday that came out of the administration, I don't think it's going to happen. And I think this market sell-off got President Trump's attention too. You notice he was really quiet in December? No. Yeah, quieter. He was a lot quieter in December. When the stock market was selling off, I didn't hear too many crazy tweets coming out. I think that got his attention. So, and remember, the Chinese stock market's down, what, 25, 30%, if not more? So China's feeling the pain even more than we are. So they want a deal too. And I think it'll be a face-saving deal. Steve Ballmer, who used to be the CEO of Microsoft, was being interviewed by Maria Bartiromo a few months ago. And she asked him what percentage of the Chinese companies that use Windows, Microsoft Windows, pay for it. He said 1%. 99% of the Chinese companies steal it. They steal everything. So it's like, we had to take a stand. Republicans and Democrats are both on the same side on this. Enough is enough. So I don't know how all this stealing intellectual property gets resolved. I think it's going to be more of a face-saving type of deal where both sides can declare victory. Ted?
Even with that, even with the opioids, and
yeah.
with those that, that's not putting more people to work here to replace all the production that's in China, which was one of the things that they were talking about. That's not happening at all. And to be realistic, there is no labor here to take those jobs.
Bingo. Yeah, right.
So it's just an empty talking point about why he's penalizing them.
Which point?
Because the fact that jobs that he's costing over there are minor because they can't find enough labor.
Yeah, right. So, yep. Sue?
Is there anything specific going on in our city that would make real estate values go down? I know Amazon is going to open in another city.
Yeah, no, I think it's all supply and demand and psychological. So I think over the short term, psychology drives prices, be it positive or negative. Over the longer term, it's supply and demand.
If Amazon opens in another city, they're not taking our work with them.
Yeah, no, they're still adding jobs here, but not as many jobs as we're going to have. Yeah. Any other questions? Yeah. All right, thanks for coming. Again, July 13th, we'll be getting to save the date out real soon. All right.